Time now for an in-depth look at the market news on this Monday, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Young, hope you had a good weekend. Thank you for coming on.
Happy to be here.
Well, last Friday, the Fed decided to let a measure it put in place early in the pandemic expire. They had been giving banks more flexibility to lend by lowering the ratio of assets they have to hold against the money they lend. So that ratio will be going up, should be next week. Tell us about that and what significance do you expect it to have?
Okay, well, this is called the supplementary leverage ratio, and we should talk a little bit about what it is. After the 2008 global financial crisis, the Fed wanted to enforce stronger capital ratio on banks. So in addition to other requirements that the banks had already, the Fed imposed 3% capital ratio for most banks and 5% capital ratio for systematically important banks. To satisfy this ratio, the banks had to hold a certain amount of cash or deposits at the Fed, 3% or 5% of their total assets. Now, at the beginning of the coronavirus in March 2020, the coronavirus vastly increased the risk of loans. The banks had to lower the book value of these loans, and as a consequence, it had a higher leverage ratio, and they needed increase in cash, basically. So they had a massive sell-off of Treasury bonds. Even though Treasury bonds are considered very safe investment, it did not satisfy the conditions of the supplementary leverage ratio. So it caused a havoc in the Treasury market. So what the Fed said was that the banks could deduct Treasury bonds and excess reserves as assets, which means banks need less capital to hold and satisfy this SLR requirement. But this exemption runs out at the end of March. So from the end of March, the banks may find Treasury bonds less attractive to hold. Now, this causes a few problems. One, because it has a higher leverage ratio, higher capital ratio that it has to hold on to because they need to have more capital now, they may reduce the loans that the banks make, which can cause hardships for people who want to borrow the money, which may include individuals and companies, but also banks itself, because if they don't lend as much, they don't get as much profits. And then there is a potential problem in the future as the U.S. government is putting forth massive fiscal policy to combat the coronavirus and perhaps invest in infrastructure. That means they have to issue a lot of Treasury bonds. Now, if the banks do not find the Treasury bond as an attractive investment, the government may have trouble selling off all these bonds. That may cause another problem in the bond market and the financial market as well. So there are a lot of questions about what the non-extension of this SLR requirement will have, but the Fed is keeping the door open, so to speak, because the banks, the Fed has said that they will examine perhaps an alternative version of this SLR rule so that the banks may not get affected by this SL rule as much in the future.
We'll have to watch the upcoming auction of treasuries in the next few days. And now stocks in New York ended mixed last Friday as treasury rates went back up. The Nasdaq posted a gain for the day, but was still down for the week. Tell us about the global markets and what you see coming in the week ahead.
Okay, well, the U.S. stocks, the Dow, S&P, and Nasdaq all fell on Wednesday and Thursday. And with the exception of Nasdaq, which rose on Friday, the other two indices fell as well. Part of the reason is the continuing fear of inflation and higher 10-year Treasury bond prices, and the non-extension of the SLR rule did not help because that may cause further price drops in the Treasury bond prices, which can result in higher interest rate which, along with the fear of inflation, can drive the 10-year Treasury bond yields even higher. Now, the European stocks, FTSE, CAC, and Euro 50, it went up until last Thursday. DAX continued to rise, but all of these European stock markets fell on Friday. That's attributed to fear of inflation, problems with vaccination in Europe, and sharp drop in oil prices on Thursday. Asia had very different results for each country in the last few days. Bank of Korea, Bank of China, both had their monetary policy meetings, both held their rates steady, but the Bank of Japan on Friday widened the band in which it allows long-term interest rates to fluctuate around its target from plus minus 2% to plus minus 2.5% to make its easy monetary policy more sustainable. And they also promised not to buy exchange-traded funds except in emergencies, which may account for a large drop in the Nikkei index on Thursday and today. Shanghai fell Friday but rose today. Hang Seng fell Friday, and it's mostly level today.
And today, Korean stocks were up and down during the session, but ended mixed. The Kospi slightly lower and a modest gain on the Nasdaq. Tell us about the local markets.
Okay, well, the local market seems to be in a sort of let's watch and see mood, partially because of the SLR rule in New York, and basically everybody is waiting to see how the market goes. Kospi fell by 0.13% to 3,035.46. Kosdaq rose by 0.34% to 955.38. For both markets, foreigners sold a fairly large amount. Foreigners sold 546 billion wons worth of stock in Kospi and $104 billion worth of stocks on Kosdaq. Individuals bought on both of those exchanges.
And we saw today that Korea's exports are up again this month, in large part on memory chips. Our viewers may have seen news about a super cycle in commodities and possibly in semiconductors. So before we go, just tell us a little bit about how a super cycle might fit into the memory chip picture.
Okay, well, I'm not sure if I believe in the super cycle myself, but the idea is that there is a cycle. Upward portion lasts somewhere between 18 to 2 years. The downward side lasts about 6 months, and it basically says that on the upward cycle, all the semiconductor buyers are buying semiconductors because they want to invest, they want to modernize, they want to increase the size of their the IT infrastructure, for example, server farms. And the super cycle may have been started this time around earlier, perhaps because of the coronavirus. We saw a large increase in demand for semiconductors last year because of the coronavirus, everybody working from home and everybody watching streaming services on their TVs. So they had to expand their server capacity. And now they're going to expand that even further, partially because the coronavirus is expected to continue this, distancing is expected to continue this year, and partially because the interest rate is still so cheap that the IT companies are borrowing to invest in large extension of their infrastructure. So a lot of people believe that because the super cycle was supposed to start this year anyway, but started a bit earlier last year, but it's on schedule to have additional increases this year. And at least so far, that seems to be coming true because the prices of semiconductors are rising fairly quickly. And for certain types of semiconductors, there seems to be very much a excess demand.
All right, Professor, we appreciate your explanation. We'll have to leave it there for today. Thanks so much for your insights, as always.
Thank you.